presentation very informal, so you can jump in at any time and ask a question if you don't understand anything. And if I know that I'm dealing with it later in the presentation, I'll just let you know and we'll move on from there. I am a tax attorney from Tax Consulting South Africa. I deal mainly with residency-based taxation, looking at double taxation agreements and financial liberation, and how to mitigate liability in terms of the change in legislation that is coming up on the 1st of March this year. Before we really get into sort of the meat of today, we need to all be on the same page in regards to the law and how taxation is dealt with in South Africa. So I'll just take you through a few slides to understand this. In South Africa, in terms of our tax legislation, we work on a burden of proof basis, meaning the taxpayer has the burden of proving their case. SARS doesn't need to prove anything. They raise an assessment saying you owe money, and it's on you to now dispute that and prove that. And that was also decided, that's not just part of our legislation, but it was actually decided in terms of our case law as well. Then beyond just burden of proof, we need to look at case law as well here, block visa, discharged on the ordinary basis applied in civil cases, and that's on a balance of probabilities. So we look at our scales of justice in this, and that is 50-50. You need to try and get over that 50% mark to be able to prove beyond, on a balance of probabilities, that your case is stronger than SARS. And what's interesting about this, and we've got more case law, it's actually more difficult than just proving on a balance of probabilities, because case law says, well, the court said, where things are equal between SARS and the taxpayer, the court must decide in favor of SARS. So it makes it even more complicated, and we can already see that it is skewed in favor of SARS. And I think when going to court against SARS, I think what happens is I think it's a 60% chance that SARS will win from history. So it is quite difficult on the taxpayer, and that's why we need to look at whatever we can to prove to SARS on that balance of probabilities that your case is stronger. And that's where this comes in. So the court also looks at objective factors and is not interested with subjective intention. So in this case, what SARS has said, I'm not sure if everyone can see this, so I'll read it out. In this regard, a court is not concerned with the subjective belief of the parties to the agreement, no matter how genuine this belief may be, but with whether the facts, objectively viewed, establish that this result was attained. It must thus consider the oral and documentary evidence, and documentary evidence is important, so remember that, to assess the probabilities. The taxpayer bears the burden of proving the Commission's decision to disallow its objection to the assessments was wrong. And whereas in this case the taxpayer is the only oral evidence, it must be considered carefully in the light of the available documentary evidence before a court is able to conclude whether or not the taxpayer has discharged the onus. So we look at onus of proof is on the taxpayer. It's on a balance of probabilities, and do you have objective factors with documentary evidence to prove your case? And then, I don't know how many of you know how SARS works, but we've got obviously many different sections in the Income Tax Act, and SARS releases things called interpretation notes, and that is their interpretation of the legislation. And it can be very useful sometimes because you get to understand how SARS is going to deal with a particular section in the Act. And often we follow those guidelines from SARS, but now we've got a constitutional court case where a taxpayer decided to use the interpretation note, but actually used the interpretation note in quite a naughty way, and thought, well, I'm going to follow this, but had done it incorrectly, and then it argued that he had followed the interpretation note in tax court, and this went all the way to the Constitutional Court. And the court then said, in those circumstances, it is difficult to see what advantage evidence of the unilateral practice, the interpretation note, will have for the objective and independent interpretation by the courts of the meaning of legislation in accordance with constitutionally compliant precepts. It is best avoided. Now this is very important. The Constitutional Court said avoid SARS's interpretation of legislation. But I mean, think about it. If you are in a civil case or a criminal case, why would you view someone else's, the party that you're litigating against, why would you view their interpretation and go with their interpretation? SARS is a litigating party against the taxpayer. So it makes sense not to take their view as gospel. The court has the job of interpreting law, and we must avoid SARS's view. And SARS often releases views. And I get calls every day from clients saying, I phoned SARS and the consultant said to me, I don't need to file a tax return because I'm working outside of South Africa. I promise you I get that call every single day, and I say, well, that's just incorrect. You cannot just follow the view of SARS, and especially not, you know, some consultant that picks up the phone. So just be careful of that. So just in summary, onus of proof on the taxpayer. And we need to just understand this, because this is how you will now gauge what you need to do going forward and how you prove what you need to do against SARS. Onus of proof on the taxpayer on a balance of probabilities. Objective evidence, we don't care about subjective evidence. And SARS's view is best ignored. Now with residency, tax residency in South Africa, and when I talk about residency, it's always going to be tax residency, not any other kind of residency. We've got two types of tests. One is the physical presence test, which is a day's test, and one is the ordinarily resident test, and that is an intention test with objective factors. So the first test, being the day's test, it looks at how many days you spend inside South Africa. And if you meet that requirement, it's a 5-year test. If you meet the requirements of that day's test, you are tax resident. Whether you want to be or not, you're tax resident. And this is often where people get confused, because they say to me, Jonty, I've been outside of South Africa for 330 days, and that's one of the sections in the day's test. Therefore, I'm not tax resident. And fine, you don't meet the requirements of the physical presence test, so you think I'm not a resident. But we've got two tests, so you need to then move to the ordinarily resident test. And this is the more important test, because there is subjectivity in it, and that's where SARS gets you, because they then get to try and interpret and make it as ambiguous as possible. Now this test looks at what is your intention and how can you prove it. What are the objective factors to prove your intention? I don't want to be ordinarily resident. I don't want to be a tax resident of South Africa. Great, that's your intention. Now, what objective factors have you taken to ensure that you can prove that intention? And that's the basis of what we're going to be working on here, and looking at double taxation agreements and financial immigration and this change in legislation to be able to prove that subjective intention objectively. Okay. In terms of non-residents, and it's quite nice to be a non-resident, there's quite a lot of benefits to being non-resident in terms of tax. You only get taxed on your South African sourced income. The worldwide income is completely ignored by SARS. You don't need to declare it. It's only income from within South Africa. Also in terms of capital gains tax, you're only going to have capital gains tax on your fixed property in South Africa after you cease tax residency. Before then, capital gains tax on almost anything that you would be able to sell. And also, South Africa is quite nice. In certain countries, when you're sending money in and out of South Africa, there's a remittance tax. We don't have that. And with the non-resident, also with donations tax and state duty, that also falls away. So there are quite a few benefits of being a non-resident.
Right. May I ask a question?
Sure. No, go for it.
You said about capital gains on the fixed property after you leave.
Yes.
So I'm in the process of financially immigrating, and I have 1 remaining property in South Africa. I'm selling it. I'll probably sell it and get the proceeds after my financial immigration has been cleared. I assume then that I'm going to be paying some sort of capital gains.
Well, yes. So fixed property in South Africa, there's always going to be capital gains tax if there has been a gain in the value of the property.
Yeah.
If it is your primary residence, you've got the 2 million rand primary residence exclusion on the game.
Can I say it's my primary residence when I haven't been in South Africa for the last 10 years?
The last 20 years, I mean, it's a bit difficult to argue that it's your primary residence. Has it been rented out?
Well, no, my parents live in.
Okay, so it's not officially rented out, but someone else is staying in it. Yeah. I don't think you'd sort of stand a chance in arguing that's your primary residence.
Yeah, sure.
Okay. Is that answer your question? Okay. So if we now look at the exemption, which is section 10102 of the Act, which I'm sure everyone has heard about in the media. This is the change in legislation, and how it currently stands is that you must be employed employed abroad, so you must be earning a foreign income. You cannot be an independent contractor. This is very important because there's a lot of people that are independent contractors or consultants, and they claim this exemption, but you cannot claim it. It is specifically for foreign employment income. There must be that employment relationship. If you meet that requirement, then you look at how many days do you spend inside and outside of South Africa. The requirement is that you must be outside of South Africa for more than 183 days, and 60 of those days must be continuous. If you meet that, currently your full foreign employment income would be exempt from tax in South Africa. That's how it currently stands. And again, important is people think I've met the requirement, therefore my foreign income is exempt. That is not true. You need to declare that foreign income on your tax return and claim the exemption. If you don't claim the exemption, you don't get the exemption and your income is fully taxable. And that's what most people get wrong actually, and I see it every day, is that they actually haven't declared their foreign income on their tax return. And with that, you often get a verification or an audit. Generally, it's just a verification where they ask for an employment contract and your passport copies to see your days in and out of South Africa. We expect to see this ramp up and bigger audits because of the change in legislation. So a history on how we got to this point of the change in legislation. There were rumors 4 or 5 years ago that government just wanted to get more revenue. I mean, they always want more revenue, but they were looking at South Africans working abroad. And they then announced in the budget speech in 2017 that if you don't pay tax somewhere else, that was just far too generous, and therefore they're going to make you pay tax in South Africa, so that the exemption, as it currently stands, wouldn't be for those jurisdictions, wouldn't be for those people that are working in jurisdictions where there is no income tax, for instance in the UAE. And obviously that ruffled a few feathers, but it wasn't too bad because many other jurisdictions there is tax being paid. But when this happened, a man by the name of Barry Pretorius, who's an engineer in the UAE, made contact with us because we had made a post about it to say there's this announcement that this is going to be happening. And we actually got into a bit of a fight with Barry at first because he didn't believe us when we said this is actually what was said. And then we sort of took him through how it was working, and he decided, okay, I'm starting the Expat Tax Petition Group, South African Expat Tax Petition Group on Facebook. Is anyone part of that group, by the way? So that's when it started, but it didn't gain much traction because it didn't affect everyone. Then in the draft tax law amendment bill, this is where everything changed. Instead of just amending to show that only income from no tax jurisdictions was not going to be exempt, they actually deleted the entire section. The entire exemption was going to be deleted. That was what was proposed. And that means everyone was affected and there was no exemption, meaning your income earned abroad was fully taxable from the first rand in South Africa. And that's really where the Expat Tax Group gained momentum and realized everyone is going to be affected and we need to now fight against that. We then went to Parliament in 2018. Barry was there as well. Barry argued from a sort of a layman's side, the actual expat, to show what is being felt by the expats, and we came from a technical side, looking at sort of the more intricate issues of tax law and how this would affect the revenue of the state as well as the revenue of the expat, and try to argue this in Parliament. At first they were very much not interested, and they had the debate because that's what they needed to do. But slowly they started to realize after various arguments that there is something that needs to be done. And that's when they came with a backdoor offer. They approached us with a backdoor offer to say, okay, we see you're fighting very hard on this. How about R1 million exemption? I mean, an arbitrary number, but that's what they decided on. And we then said, okay, we're very thankful for something. And what about fringe benefits? And they said, sure, and fringe benefits are your housing and your car allowance and schooling and all of that, because that's all lumped into your salary and what will be taxed. And they said, yes, we will look at it. And have they looked at it? No, they haven't. So we're not unused to them not keeping their promises. Similar thing happened with, they also said they'd look at changing the R1 million inflation and exchange rates and how we're going to deal with that. And a few years ago, when there was a cap put on retirement annuity contributions, it's at 350,000 Rand and 27.5%, they said, oh no, we will, as inflation happens, we will change this year by a year. And that's 4 or 5 years ago now. Has that happened? No. So we're sitting in a very similar position where it probably won't change. But at the same time, you never know, I suppose. So then in December 2017, the law was actually promulgated. And often people say, well, is the law even in place? Is it going to change? The law is here. It was put into law in December 2017. It's not going to change. We went back to National Treasury in March, was it 2019, and we did another thick submission to them explaining what needs to happen and how this is not going to work properly, and are you ready for this? And they said nothing's going to change, the law is in place and there's no further amendments. And they also said to us, you can with pleasure keep on putting submissions in. You can put as many submissions in as you want, and we'll read them, but we answer to our political superiors. Those are the actual words, we answer to our political superiors. And then we realized we're fighting a losing battle now, because we're not speaking to the people that can make decisions. And the decision has already been made, and we now need to try and look at ways to mitigate damage. SARS has also released some frequently asked questions. I think they've released, there's 2 issues of it. There might be a third. I don't know if anyone has read those frequently asked questions. Again, it is the view of SARS, so it's best to be avoided, right? But when I've read it, and I've read it many times, from one point to the next, one question to the next, there's contradiction after contradiction. So my view is it is best to be avoided. So reasons for the law change. We've got formal reasons that were given, and we've got our speculative reasons, and you can decide what you think is true. But Parliament said, or by SARS had said, that there was only about 4,800 tax returns filed claiming the Section 10102 exemption. 4,800 tax returns. We know that there are thousands and thousands and thousands of South Africans working abroad. So it just didn't add up. And you took the 4,800 tax returns, and you take the amount of people that have financially immigrated and ceased tax residency, you put those 2 numbers together, and it comes nowhere close to how many South Africans are working abroad. So they saw huge non-compliance with the South African taxpayer, and they thought it's time to now crack down on this. And I don't know how they decided by changing the exemption this was going to crack down on non-compliance, but that was one of their formal reasons. And another one was economic double non-taxation, which really has no sort of bearing from a personal income tax perspective. It really comes from OECD, control of foreign companies and all the rest. So that didn't really make any sense. Now, from our view, the speculative reasons, if you can call it that, when you cease residency in South Africa, no matter how you do it, there's going to be an exit charge, depending on what assets you have. But it's called a deemed disposal for capital gains tax purposes in terms of Section 9H of the Income Tax Act. And people were leaving South Africa, ceasing residency by means of not meeting the requirements of the residency tests, but they were not paying their exit charge. They were not following the formal route to exit from SARS, and SARS was realizing this. So now they decided, okay, well, let's make this more complicated. Let's try and get as much revenue as possible. And while people are ceasing residency, we can get our exit charge, and then fine, we're done with it, and they can carry on. So we know for a fact that most people have not done the exit charge, because most people don't know that there's an exit charge. So we're dealing with that every day, with getting that done properly and having that declaration. The other issue, which I also mentioned earlier, was the independent contractor versus an employee. And there were so many independent contractors that were claiming the exemption or not claiming the exemption, and a lot of the cases not claiming the exemption, but thinking they are exempt from tax, when actually they should have been paying tax in South Africa. They were not exempt. So another reason why we think SARS is cracking down on that. And then obviously the easy one, SARS needs money. The government needs money, and that's where we stand. Now, I'm not really going to go through all of this, but this was the formal responses from National Treasury on our first submission. And there were summarized to 1,308 comments regarding this change in legislation. And that was after all of the duplications and everything. So this is just how National Treasury responded. Now, it's very interesting here. You'll see there's four types. Yes.
So if someone sold all their assets a couple of years ago, and this is only coming into effect now, would there be no deemed value now that they would have to pay this exit?
So if we just take one step back and then maybe you can re-ask the question. This change in legislation has nothing to do with the exit tax.
Okay.
So the exit tax has always been there, and when you cease residency, worldwide assets, you must pay an exit tax.
But if you sold everything when you left?
So before you left or when you left? I mean,
Before you left,
you would then have been still a tax resident in South Africa, and you would have paid actual capital gains tax. And it's also, I mean, I'll get into it a bit later with capital gains tax, but it's not all assets. So for instance, your fixed property in South Africa, there is no deemed disposal. But your fixed property outside of South Africa, there would be, and you'd have to pay capital gains tax on that. Okay, does that answer your question?
Yeah.
Okay, so if we look at the types of responses you get from National Treasury, you've got four types. One is accepted, meaning they agree with your view and they'll make the change. Then you've got not accepted, which is self-explanatory. They don't agree with your view and nothing's going to happen. Partially accepted, and they'll do a bit of an amendment. And then the funny one is noted, which we read as you agree with us and you see our point, but we don't really care and we're not going to do anything about it. And this is an important one here. The comment that was given to National Treasury was that this proposal, the change in legislation, will lead to an accelerated breaking of SA tax residents, including people who have been out of the country for more than 5 years. Some had envisaged retirements in South Africa, but will now not be willing or able to do so. Response, noted. The formalization of the tax residency status of the South African tax residents who left the country many years ago is to be encouraged. South Africans who are no longer tax residents are welcome to return to South Africa in the future, and there are no barriers from a tax perspective to do so if their tax affairs are in order. I mean, make of that what you will, but just from that response you can see how short-sighted the view is. And we're seeing it. We're seeing an accelerated breaking of tax residents. We're seeing it all over because people don't know what else to do. If they pay the tax, they can't afford to live abroad because the cost of living is so expensive. They can't come back to South Africa because there's no jobs. So, and it's also now making it more difficult for a South African to work abroad, because often what happens is that person will go to their employer and say, well, this is the situation. I'm contracted with you to be paid this amount per month, but actually I won't be receiving that because I have to pay this tax over. You're going to have to, it's called grossing up, or tax equalizing, give me more money. And what happens with that, and what we're going to see, and I'm certain of it, is that the employer is going to say, we've got some great guys from South Africa, but they're just too expensive. I'm going to go get a professional from a different jurisdiction. And that means we're making ourselves unemployable abroad, and we're unemployable in South Africa. So, short-sighted. And then breaking of tax residence, well, SARS then thinks I'm going to get more revenue from this change in legislation. Well, actually, no. People are now saying to cut ties with South Africa, and therefore less revenue. So, fun and games with SARS and National Treasury. Okay, so this is the new law wording. It's very similar. The only addition to it is to the extent to which that remuneration does not exceed 1 million rand in respect of a year of assessment. And that just means that the exemption remains the same, the requirements remain the same, capped at 1 million rand. Everything above 1 million rand would then become taxable, would then be taxable in South Africa. If you don't meet the exemption requirements, everything is taxable as it always was. Now, if we just go into some South African Reserve Bank terms or exchange control terms, in their manual, in the regulations, they speak and they show how to financially immigrate. And part of the process is an application to SARS to get an immigration tax clearance certificate, and part of it is an application to the Reserve Bank for a conclusion letter to change the status to immigrant. With the immigration tax clearance certificate, that is the full notice to SARS that you have ceased tax residency. Okay, so why is it still unfair, this change in legislation? So part of our submissions to National Treasury and to SARS, we gave examples of different scenarios. And in this scenario, we had taken the sort of ex-con members of a big corporate who had these guys in different places in Africa. So they've got very big salaries, and we showed what the tax liability in that host country would be. We said that's what they'll be paying there. And with this change in legislation in South Africa, that would be the liability. And then we showed the variance of how much more tax they would have to pay based on this new legislation. And you can see for yourself an extra 600,000, extra 2.3 million rand. I mean, I don't know who's got all of that lying around to just pay to a country they're not living in. And maybe they come back for holiday or whatever it may be, but that's a lot of extra revenue for the tax authority. And this one Nigeria, it's so high because my understanding in Nigeria is what happens when you go there, you have to, an expat has to be on a specific part in Nigeria. I think it's on an island right there, and you have to pay the rental 12 months up front. And if you say no to that or try to argue with that, they'll just give it to someone else. And that rental is taxed, I think, at 5%. But because it's such a large amount of money and it's very expensive, the equivalent would be probably at 45% in South Africa. So you've got this 40% tax burden in South Africa just on that rental alone, and that's why there's that huge variance for Nigeria specifically. We also then gave the volatility of the rand as one of the reasons and why 1 million rand makes absolutely no sense. How can you just choose a random number, and how can we not have something put in place that allows that number to change as our rand changes, as interest rate change, all of that. And we showed just for 11 months, the weakening of the rand. We've got 12%, 7%, 13%. And then we took it back by 10 years and we showed. And we said, well, look at this. Rand to the dollar, 106%. Rand to euro, 61%. British pound, 32%. Australian dollar, 70%. The dirham in the UAE, 106%. So then it showed the severity of the issue. And the problem is they noted it. They did not do anything about it. They mentioned that they might, we will look into changing it. But as I was saying earlier, they promised that before and they have not done it. So I'm hopeful that they will look into it, but I don't think it will happen. The million rand is here to stay, unfortunately.
Sorry, Jonty, on that, have they stated, I mean, exchange rate will come into effect, because again, most people are dollar-based. Have they stated when that conversion is deemed to happen?
Okay, very, very good question. So
End of
SARS,
the tax year, end of the month?
SARS releases average exchange rates every year. It's on their website, and those are the exchange rates you can use. And they're actually often better than the bank's exchange rate, so I would use those. But you get to make a choice. You can either do a spot rate or the average rate. And what's quite smart about that is we had a client where we saved him about 400,000 Rand because we decided to use the spot rate instead, and he was getting a big bonus right at one part in the year. And instead of doing, and because of that huge bonus, we decided if we do it at an average rate, you're going to be paying this much tax. If we do it at spot rate, and maybe the other spot rates weren't great for the other months when you were paid, but because this bonus is so big, we do it on this, and we actually got a huge savings. So you get to make the decision on spot rate or average of the year. Okay, so is 1 million Rand enough? I mean, we know it's not, but look at the things that will be taken into account. You've got your accommodation, home security, vehicle insurances, medical aid, tax services, school fees for the kids, home leave, trips, you get flown to and from home, a driver. That's all included in what is looked at as your salary. It's the full package, not just the cash component. And for some jurisdictions, especially in Africa, you're not allowed to drive. You have to have a driver. And beyond that, you have to have a security detail with you. You cannot do it on your own. It's just part of how it works there. And you think to yourself, well, that is not a luxury. Why am I being taxed on it? It's an absolute necessity for me to perform my duties at work, to get to and from where I need to be. And unfortunately, and that was part of what was argued in Parliament, they decided that, basically noted that that's part of your salary, and that obviously then eats up into your 1 million Rand very quickly just to have necessities to perform your job. So yes, 1 million Rand isn't enough, but unfortunately that's what we're dealing with. Now, we have created an expat tax calculator. You can go onto the website. This can be sent out to everyone afterwards. This is the slides, and it just gives you an idea of, if you do nothing, what your tax liability would be in South Africa, taking into account maybe you've paid some tax in your host country, to see what your liability would be in SA. It's simple, but it does the job just to get a good idea. So feel free to use that. Okay. So in our practice, what we like to do, and the reason we do it specifically this way, is because what was brought up in Parliament about non-compliance with taxpayers. And the first part of our process is to do a tax diagnostic on your profile, your South African tax profile. And what we get so often is people say, well, no, I've got a tax practitioner or a tax consultant, they do my tax returns every year, and it's all up to date, and it's fine, and why do you want to look at my profile? Why do you want to do an audit on my profile? And I actually reject clients, and I say, well, then you can go to a different firm to deal with this then, because I'm not going to touch or advise on anything until I know exactly what's going on in your profile. Because what have you declared, or what have you not declared? What, in terms of onus of proof, what are you showing on that profile for you to come to me to argue that this is my position? And what is often the case, and this is the number one issue that I see, someone tells me that their tax practitioner has filled in their returns and they're all up to date. I go and have a look, and what has happened is the tax practitioner has ticked a little box that says unemployed. Unemployed. So, and why they do that is because no other boxes come up then if you say you're unemployed. That person is not unemployed, they're just working outside South Africa. And even worse, they're working outside South Africa, they've got a property in South Africa, they're getting rental from it, they've got a bank account that's earning interest, there's income in South Africa as well. So the tax practitioner thinks, oh, this guy's working abroad, easy one, we just file saying unemployed because it's simple. And that's a big problem, and we'll get into why that's a big problem a little bit later when we deal with criminal offences. But 1 million Rand is enough. 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 that's how we start our process. We need to look at what your tax status is so that we can then plan from there. Okay, so non-resident planning. You're either ordinarily resident in South Africa, or you are making use of a double, or not, based on if you financially rating to formalize that or not meeting the requirements of the residency test, or you remain ordinarily resident, but you claim residency of another country, of Mauritius as well. And that's when we look at a double taxation agreement, which we'll get into right now. So first, financial immigration. It's a once-off process, formalizes with SARS and the Reserve Bank that you're non-resident. Keeps it very clean. The only big issue, little issue, depending on how much you're dealing in South Africa, is your bank account changes status from resident to non-resident. And it's not too much of an issue actually, and exchange control regulations are loosening as we go, but your internet banking is restricted, and generally you've only got viewing access and not transaction access. So what happens is they provide to you a relationship manager, which is very much a personal banker, and you would then instruct that to that person to make payments or transfers. But you can still have debit orders running like normal. You still have functionality of the accounts, it's just a bit of extra admin.
Sorry,
Yes.
can you financially immigrate if you are deemed to be an ordinary resident of South Africa?
No. So, I mean, you can, but it's going to mean very, very little. You're going to remain tax resident, and it's going to contradict your status then.
Okay.
So wouldn't mean much then. And then also with financial immigration, you can withdraw your retirement annuity early and your pension providence fund early without penalties per se. And you get the tax clearance certificate immigration from SARS, and that's the very important document to get. If we then look at the DTA, the difference with this is financial immigration you use when the plan is not to return to South Africa on any permanent basis, because then you are not ordinarily resident and you can formalize that status. If your intention is certainly I will be returning to South Africa, then you look at a double taxation agreement if there is one in place. With Mauritius there is a double taxation agreement in place, and the reason you do it this way is because you remain ordinarily resident in South Africa if your intention is certainly to return. But you could also be a tax resident of Mauritius, and now we look at the double taxation agreement to assign a tax right to one of the two countries, but you have to meet certain requirements. Also with DTA, there's no change in bank accounts or anything like that. What is the same between the processes? You're ceasing residency with both of them. One is a deemed cessation of residency under the DTA, and one is an actual cessation. But in terms of our Income Tax Act, both are seen as a cessation, and therefore there is a CGT, an exit tax implication there.
Excuse me.
Yes.
Is there, once you have the status of DTA in Mauritius, South Africa, is there a common reporting system between Mauritius and South Africa?
I'm pretty sure Mauritius and South Africa are both part of the common reporting standards.
Yes.
Yeah.
But with common reporting standards, is the reporting requirement supposed to be back to the jurisdiction where you are a tax resident?
Yes.
Okay,
Yes.
so
And
if you're a South African citizen but a Mauritian tax resident, and you had a bank account in the Isle of Man, for example, that bank would have to report to the Mauritian tax authority where you are a resident. Would the Mauritian authority then report you to the South African tax authority?
Most likely, and probably what would happen is actually that bank account that's reporting to both jurisdictions, because they see you've got a bank account in both jurisdictions, you've got assets there is.
Okay.
Yeah. Sorry, I saw another. Yes.
Sorry, if you earn dividends in Mauritius,
Yes.
which is not taxable, is it part of your revenue as well?
Well, it depends if you are a tax resident of South Africa. If you're a tax resident of South Africa, it's absolutely taxable in South Africa, because you're taxed on worldwide income.
Unless you financially immigrated.
Correct.
Okay.
Then you're non-resident and it doesn't affect you. Yes.
The gentleman that just talked there is wise to consider, we say there is no tax on dividends, but there is tax over 3.5 million rupees income, so therefore, there is.
Yeah, sure.
Over 3.5 million.
Yeah, I think the point of the question was whether it's taxable in South Africa or not, and it comes down to are you tax resident of South Africa. If you are, it's taxable. If you're not, it has nothing to do with South Africa.
But it's on 3.5 million, it's 3.5 million.
Yeah. Yeah.
Sorry, one last question.
Sure.
With the DTA, does that exempt you from your worldwide income in South Africa? Or does the DTA only protect you against your income?
No. So it depends how you use the DTA, but generally we're looking at Article 4, which is the tiebreaker test, which I'll get into very soon. But basically, if you use that article, then no, you are saying you're a non-resident and you wouldn't be taxable. Use certain other articles, well, then it's based on certain types of income. Okay, and also financial immigration, DTA, there's absolutely no effect on your passport or your residency from a home affairs status. This is tax and exchange control residency, that when you're financially immigrating. Okay, here is the piece of gold you want, and we go back to onus of proof and objective factors. This certificate, tax clearance certificate immigration, is what you want to get. Because if we are looking at it from a perspective that we're going to be fighting SARS in court, you want to have this certificate to say, you've already audited me, you've looked at my affairs, I've paid my exit charge, if there was one applicable, and you gave me a certificate to say that I am out of the South African tax net. This certificate is worth its weight in gold. And this will also stop you from even having to go to court. So if SARS can see that they have done that process, a formal process for you to exit South Africa, well, they think to themselves, well, what is the point of now trying to fight this guy in court, because he's done this process. So it mitigates that risk up front. I mean, obviously, if you have to get to court at some point, you want to have this certificate to say, well, court, you interpret this how you want to interpret it, but clearly I've done what I needed to do to formally exit South Africa. Okay, the double taxation treaty, or DTA, and what's up here is Article 4, which is very interesting. How are we doing for time? Okay. Article 4, so the tiebreaker clause, and very interesting one. And how it works with the DTA is not that you must meet all the requirements. What happens is you look at the first requirement, and if in that first requirement you can assign a taxing right based on you meet that requirement, then it falls to that country immediately. You don't need to look at the rest of the requirements.
Can I ask you something?
Sure.
Do you have any general tax avoidance rules in South Africa?
Yes, we do.
So if somebody buy property in Mauritius
Yes.
simply to avoid to avoid taxes, would that fall into a GPA?
Well, I mean, it depends, I suppose. I think I'd need more details. But if it's simply to avoid tax, I don't know how you'd be avoiding
if
tax.
the main principal purpose, if on the balance of probability,
Yes.
is to avoid taxes, what is?
Well, yes, then it would fall within the provisions, and you would have to deal with that issue. Okay, but on the DTA, first requirements. Where does the individual have a permanent home available? And permanent home is viewed widely, meaning you don't have to own the property. You can be renting it. And if permanent home also means it just must be available to you at all times. So if you've got a property in South Africa and you can go back at any time and live in it, you've got a permanent home available there. But if you're renting it out, you don't have a permanent home available there. And if you're renting out a property here where you live or purchase one, same thing applies. And let's say you've got a permanent home available in both jurisdictions. Well, then it's a tie, and we must go to the next point. And that is, if a permanent home is available to the individual in both states, the individual shall be deemed to be a resident only of the state in which the individual's personal and economic relations are closer. So second point, we're looking at your center of vital interests. And they've split that up into personal and into economic. Economic, you look at where do I hold my assets, where do I earn my income, where do I spend my money, and personal, well, where is my family? Where do those relations sit? And the biggest issue, this is where most people fail, is because they are working abroad and their family, their spouse is sitting in South Africa with their kids, and they're going to school there. And unfortunately, your personal relations are closer in South Africa then, and your centre of vital interest will fall in South Africa. And that means at that point, taxing right falls to South Africa. DTA doesn't help you. But let's say it's not so clear cut, and again, we fall to a tie. And if you can make it fall to a tie, then it becomes easier again, because it asks, where is your habitual abode, meaning the property that you return to on a day-to-day basis. And if you're working outside of the country, well then the property that you're returning to on a day-to-day basis would be in that country, and that makes it easier again.
And if you meet the first requirement, then won't look at the other.
Exactly. So if you're using DTA, my advice is to you, and you've got a property in South Africa, rent it out, and make sure you've got a rental agreement in place, so that you don't have it available to you when you're in SA. Go stay with family or get a hotel or something, and make sure you've got a rental agreement in place in Mauritius, so that you can say, I do have something permanently available to me. Then we don't need to look at the rest of it. If you just go to the next point, then it's still a tie. You look at where you're a national, it's still a tie. You then go to the mutual agreement procedure, and that's where the tax authority in South Africa and the tax authority in Mauritius would then have to come to an agreement where the taxing right falls. You don't really want to get there. Before you even look at the DTA though, this is the certificate you need. This one is for the UAE, but it's a tax domicile or a tax residency certificate. This certificate opens the door for you to be able to use Article 4 to claim exemption under the DTA. If you don't have something that shows that you are a tax resident of the other country, well, you can't be claiming DTA relief then, because the DTA there is there for someone that is tax resident in 2 countries under their domestic laws, and now the international law must decide a taxing right. Yes?
Just one note in here, you have to ask the MRA here. It's 1,000 rupees, and they won't just give it to you.
Yes.
You simply have to apply, or you can ask for a management company to apply, and it's 1,000 rupees for each year, so it's fairly easy to attend.
Yeah. So that's also my understanding. And I think the requirement is that you must be in Mauritius for 183 days of the year.
Correct.
And that's under the DTA to claim residency. You must meet that requirement. But once you've got that, that's your objective documentary proof that you can now use the DTA. It doesn't mean that the taxing right falls in Mauritius, because you still need to look at Article 4 and go through the different factors to decide where that taxing right will fall, and be able to prove it when SARS audits you. Okay, in terms of resident planning, so you are not financially immigrating, you're not using the DTA, so what are you going to do? You're going to claim that exemption, the 1 million rand exemption, so you meet the requirements of that. And then there are certain other factors or options to use to reduce your liability, but it's never really going to take it all away. We then also look at employment versus independent contractors. So the independent contractor doesn't have that exemption, but an independent contractor can claim deductions on a whole bunch of what they're doing to generate their income. So it might actually work well to be an independent contractor, also maybe not. You could also be employed and an independent contractor. You don't only have to be one, and in that you can claim the exemption and you can claim deductions, but obviously that needs to be set up correctly. And then another one, and this one you just have to be very careful of, and we see a lot of this, is you own your own company, so you're an independent contractor, but you are also employed by your own company. And you can do that, but it goes back to anti-avoidance provisions that you mentioned. You don't want to be caught out with that, because that then gets very dangerous. So that needs to be set up very carefully, and all the agreements put in place so that you can have that. There are some fringe benefit exemptions in terms of, for instance, accommodation. If it is from an employer that doesn't give you the money but actually pays for the accommodation, you get a certain amount every month that you could claim for the first 2 years. And then end of service benefit. I understand in Mauritius that isn't a thing. It's very big in the Middle East, where for every month or every year that you work there, you get a one month salary. And that is very much their way of saying here's a pension for you, but it's not a pension. And SARS has said an end of service benefit is fully taxable. So those people that are thinking, great, here's my pension, retirement, I'm going to leave here and go back to South Africa, and that's going to be a very big amount of money that's going to be taxed at 45% because it's certainly going to be over 1.5 or whatever the number is, that is taxable. But we are willing to challenge SARS on this, and we're actually looking for a candidate to approach SARS and ask for a ruling on it. But that means that person needs to open themselves up to an audit, put a red flag on them. So if anyone knows of a friend in the UAE or Saudi Arabia, whatever, please send them over.
Excuse me.
Yes.
With reference to the fact that you could have your own company.
Yes.
And be employed by your own company, which is probably going to be useful to avoid tax. What if you are only shareholder in Mauritius and you actually only claim the dividend that would be accepted?
You claim the dividend, you said?
Yeah, you only get paid the dividend. So you're not employed by your own company, but you just take the dividend because up to 3.5 million rupees income they're not taxable.
Okay, but are you saying that if you are remaining a tax resident of South Africa?
No, if you're here in Mauritius, you're employed by your own company, would that have an impact on the South African way of...
Yeah, but we first need to decide if you're tax resident of South Africa or if you're tax resident of both.
If you're tax resident in South Africa,
Yes.
you can still have a company here in Mauritius.
Yes.
Right?
Yes.
That will be then subject to the self-employed. Will that come in as dividend only being paid out?
So, you're not a director, you're just a shareholder of a company, you're getting paid a dividend.
Correct.
Well, I wouldn't say that is employed or an independent contractor. That is just you having shares in the company and earning dividends.
It's not in bad faith of the law.
No. I've got no issue with that at all, and I don't think the law does either. You just need to take into consideration if you remain tax resident, that's going to be taxable in South Africa.
Would it make a difference if you're an alternate director or a director in the United States?
Yeah, a dividend remains a dividend, but now if you're looking at director and you're saying you're employed by that company as well, does that form part of your salary? The point is it's taxable in South Africa if you're a resident, and there's no issue with being a director and a shareholder and receiving that dividend. There's nothing wrong with that.
Because you can be a director and not receive a salary, right?
Correct. Yeah.
But you want to become ordinarily resident in Mauritius.
Yes. Exactly.
It's a residence. You've got residence and that's it.
Exactly.
Does that include director's fees? If you just, a non-executive director, you get director's fees?
What do you mean by does it include that? The exemption?
It includes your revenue then?
Yes, absolutely.
Not exemption.
Correct. Okay, so for those people that are returning to South Africa and they remain tax residents, so you can't financially immigrate, maybe you can use the double taxation agreement. In the meantime, before you return to SA, before you re-enter South Africa, this is very, very important. Don't just return and decide, okay, I'm back in SA. You need to do proper planning so that you're not taxable on all of that income and assets before you re-enter. And you look at tax wrapper structures like unit trust, for instance, and those can be very, very useful. And there's a whole bunch of other ones. But in terms of, and especially for the UAE guys with this end of service benefit, you don't want that to be taxed, so because you can't financially immigrate, so you need to look at using that DTA to say, well, while I've received this, while this has accrued to me, it is non-taxable. Then I re-enter South Africa and with my investments and all the rest and become a tax resident again. Otherwise, you could, I've seen it a few times now with people re-entering and the tax liability is massive because they have not done the planning beforehand. And now that they've re-entered, the tax resident again, there's nothing we can do about it. So just be very wary of that. Okay, some yes.
Could you use the DTA almost as a short-term solution for this year, implying that you're going to go back and then apply for immigration maybe in a couple of months' time or a year's time, and then backdate your immigration?
Yes, so making use of the DTA in that way, I don't have an issue with. So short-term, definitely, I would use the DTA. And that's especially if you're planning to come back. But if your view is that you're not coming back, I would say there's no point in using the DTA, because part of using that DTA in Article 4 is saying to SARS, I'm remaining an ordinary resident of South Africa, and that could complicate things when claiming a backdated financial immigration, because you've now stated that you are a resident under the DTA.
Sorry, just repeat that, please.
So, if you claim DTA exemption under Article 4, DTA is then because you're a tax resident of 2 countries and you're signing a taxing right. If you're claiming that Article 4, you are saying to SARS that you are actually ordinary resident of South Africa and tax resident of another country. Now, trying to backdate your financial immigration, I don't foresee it really being an issue, but if SARS wanted to be very difficult about it, they would then say, well, you've seen that you're ordinarily resident in South Africa, even though the taxing right falls somewhere else, how can you now backdate your financial immigration? That's in theory that it causes an issue. In practice, what we've seen is that it's not an issue, because when you are claiming relief under the DTA Article 4 specifically, you're going to be filing, because you're ceasing tax residency, you're going to be filing, or you're deemed to cease tax residency, you're going to be filing as a non-resident as well, meaning you're not going to be declaring your family income. So your tax return objective factor is not going to show that you've claimed DTA relief. It's just going to be, I'm filing as a non-resident, and SARS can then raise an assessment to disagree with that, and then you'll prove that I'm a non-resident under the DTA. If they don't raise an assessment, you've just filed as a non-resident and you carry on. And then backdating is very simple, because again, on objective factors, what is on your return? Well, nothing, because I'm a non-resident. I've only declared my South African source income. So from an objective factor point of view, no issue whatsoever.
Depends on intention, I guess, long-term intention. Because if you have no intention of going back to South Africa, we are already non-resident. Well, we are,
Yes.
no matter the fact we are non-resident. So you just buy a non-resident, just...
The problem is timing because of the deemed, because you still have a company in South Africa.
So you
want to wait for a bit of time.
I understand. Yeah. There's also...
You pay tax on something that you haven't sold.
I know, it's a big cash flow problem, yeah.
Just a quick question, Jonty. Considering that life is a changing thing, in a situation where I've got a financial immigration, I've gone through the whole process of financial immigration, and my circumstances change, can I reverse that?
Absolutely. Very good question. So, if we just look at our residency test, based on intention, and intention can change. SARS or government is not, and even in their response that said noted, they said we encourage the formalization of your tax residency status, and there's no barriers for you to come back to South Africa. So your intention can change. The issue really is, and this is where you have a bit of a discussion with the clients, is that they say to you, no, I'm not returning to South Africa, but actually I am going to return to South Africa. You say, well, what is it? Because if your intention right now is that you are returning, we're not going the financial immigration route. If it is, in 10 years, I'll see how it's going here, I'll see what the political climate is like in South Africa, and maybe then I'll decide to go back to SA, but it's not a sure thing. And that's absolutely fine, because your intention isn't to return to South Africa, but it could be. You can have the change of intention, and you would just reverse the process. Basically an application to the Reserve Bank to say that you've returned on a permanent basis, changed my banking back to normal resident banking. A letter to SARS to say that you've returned on a permanent basis, I'm a tax resident again, and you start filing the tax return as a tax resident, declaring worldwide income.
So, a question, liaison with what was touched on earlier. I've applied for financial immigration. I don't expect that it's going to be finalised by 1 March. It'll probably slip over maybe another month or so. I don't have to worry about anything. I just want to, but I'm backdating my financial.
Well, there we go. So that means you're non-resident from the date that we are...
About 10 years ago.
Yeah, well there we go. So the point is we're doing an application to SARS and to the Reserve Bank, but importantly to SARS, and that application has a date of exit on it. That is where SARS would also ask for your deemed disposal on your exit date. if there is one to be asked for.
Yeah.
SARS is then accepting that and giving an immigration tax clearance certificate based on the application being backdated. So they are confirming non-residency from their point of view based on that application. SARB then does the same thing. SARB is a bit more difficult with backdating, but we're not too worried about an exchange control residency issue mismatch over there, as long as they in the end accept it.
So, the date in which I left, I didn't own a property in South Africa. I'm interested afterwards, I'm still going to have that capital gains liability.
When you actually sell the property.
Only when I sell it.
Yeah, because it's in South Africa, there's no CGT for deemed disposal on fixed property in SA.
Yeah. Shane, just to clarify further, so that change on 1 March is prospective. So any additional tax on the amount above $1 million would only apply prospectively, not to any previous.
No, that's what I'm saying. It's like after a month, let's say 2 months where I'm earning over $1 million, I don't attract liability there.
No, your immigration is backdated. You're non-resident from a further date.
It's not even backdated, it's accurately dated. It's the date when you actually left the country. You're saying that is the date, it was the intention to leave the country.
Yeah.
Even if that goes for a couple of months, that $1 million is deemed per annum, not divided by pro rata basis.
Well, so part of the frequently asked questions from SARS again complicates things, but basically how they've said it's going to work is that you get paid and you use up the R1 million as it goes, and then it would start to apply above that. But again, I don't know how well that's going to work and how they're going to judge that. And we've seen this a lot from a company perspective as well. Payroll in South Africa, how on earth do we get this right? And make sure that, is this person going to meet the requirements of the exemption? Should we be withholding tax? Do we need to get a ruling from SARS to say we don't need to withhold tax on these guys? So from a company perspective, it is becoming a huge headache. And surprisingly, I've been trying to deal with from a company perspective for some years now on this. And in the past sort of 2 or 3 months, I must have sent out 100 proposals, because only now they're thinking, wow, okay, we need to do something just before the change in legislation. So I'm surprised at how companies have been so slow to deal with this issue and their expats all around the world. Okay, criminal, yes.
Just one question. Let's say you do the exit, and then after 5 or 10 years your intention changes. Now you think, I want to go back, and you do go back. Once you've done the exit, does that remain the base cost of your asset?
Exactly. No, so what happens is, let's say you exit and you've got assets in South Africa. At that point you pay your exit tax, and that value then becomes the new base cost. Anything from that point where it grows, that would be the new tax. But if you cease tax residency, you paid your exit tax, and then you return to South Africa and gain tax residency, you look at the value of that asset at that point, and that is the base cost.
On the date you re-enter.
Exactly. Or the date that you gain tax residency again. Yeah. Any question?
Yeah. Just on your question about a company in South Africa. If you actually become tax resident in Mauritius, so you tick the box for the days and ordinary residents in South Africa, and then you financially immigrate, right? Would you still then have the deemed disposal of the company?
So, yes. So if you are ceasing residency after gaining that asset, there would be a deemed disposal on it, because while that forms part of your assets while you are resident, then you cease it, even if it's only a month, there would be that deemed disposal on that company that you would need to do.
And if I pay the capital gains tax as if I've sold the company and I sell it for a higher price in a year's time.
So interestingly enough, once you're non-resident, there is no capital gains tax on shares. So in South Africa. So
we have to look at the rules where you're resident at that time.
Well, yes, that's a very good point, because then if you're resident somewhere else, you might be taxed on your worldwide income, and there you've got that capital gains tax liability somewhere else. Okay, can I move on?
Yeah, can you be running a little bit over?
Okay, I will.
Criminal stuff is important, let's make sure that Mr. Joe.
Yeah, the next few slides I'll run through quickly, but basically we're just looking at some criminal offences and just see how wide these sections are and how simple the offence can be, which is actually criminal. So a person who willfully and without just cause fails or neglects to register or notify SARS of a change in registered particulars. I mean, you haven't put on your correct address and that's changed, or you haven't registered for tax and you were supposed to, criminal offence. Submits a false statement, fails or neglects to retain records. You know, it's very simple, these things, which actually a lot of people make these mistakes and they've got no clue that it's actually a criminal offence. I highly doubt SARS will take you on criminally for something as simple as that, but the problem is it's still a criminal offence and you don't want to end up having to deal with that. You're looking for this section up to 2 years in prison. We go to the next one, it would be 5 years in prison, and that would that's for more evasion of tax. So I mean, you can read through this. I'll send you the slides. So I mean, this Judge. So we wrote the LexisNexis book on expat tax. Was published last year. We're very proud of it. And Judge Dennis Davis of the Davis Tax Committee in South Africa actually wrote a bit on the book. And this is just a part on ceasing tax residency and capital gains tax. And the question came to our mind, well, when the Guptas left, did they pay an exit tax? You can decide. Okay, so quickly through an audit. This is specifically on rental. So you can have many different tax types, but this is specifically on rental, and look how detailed it goes. You know, kindly furnish the following for both rental properties: address, date of purchase and purchase price, state the method and sources of finance, state your intention when acquiring the property. What were the factors that convinced you that the profit could be realized? If the property was unlet for any period during the statute, please state the periods. Give the lease, copy of the deed of sale, bond statement, furnish a breakdown and proof of all repairs, a breakdown and proof of other expenses claimed. I mean, and that's just for rental, so they can really deep dive into everything. And now here's a light expat audit, and I promise you this is a light one because I've seen some really, really scary ones. And just look at all the different things they ask for. Your employment contract, proof of foreign income received, days in and out of South Africa, capital gains tax calculation, rental, all the rest. But the last one is the most important here. Bank statements for the financial year's audit. And they don't say which bank statements. So you think, well, I'll give my South African bank statement. No, they've asked for bank statements for your financial year's audit. That means all of your bank statements. They want to see what money you've earned all around the world. And you only give them your South African bank account. Great. And maybe you get away with it this year. But the problem is with the common reporting standard, they're getting this information anyway. And if they see that you have not given them everything, or you've decided to only show South African source of income on your return, and actually you've got foreign income, you've remained resident, you've now understated your income. Are you evading tax, or was it a mistake? And then you've got penalties on that, or worse than penalties, you've got criminal sanctions on you. So with the common reporting standard, I know it's still pretty new, but please just be aware that this information is being shared, so you cannot hide. Okay, and then here's just a recent case with some of the big four and BMW, and all it really shows is that SARS is targeting expats now. I mean, they've created an entire foreign employment income team. This is expats in South Africa though. So the point I'm just trying to make is that right now SARS is not, the best at doing anything, but they are a state organization that does work for the most part, and they've got a team set up to now deal with this change in legislation. So we are going to see a stronger side of SARS, I think, with bigger teeth, and it might take a while, but I do think it is coming. And that's just our book, Expatriate Tax, South African Citizens Working Abroad and Foreigners in South Africa. And from Judge Davis, In summary, this is a carefully considered book which deals with all the various tax implications of immigration and immigration. It is the most welcome addition to our body of tax literature and will doubtless be essential reading for anyone advising his or her client with regards to the tax consequences of migration. I'm just tooting my own horn here because I'm very proud of the book. Yeah, that's it from me.